right, we are back with another episode of the Real Estate Investing Club. Today we have Brennan Degner with us from DB Capital. Brennan is here from the multifamily side. We love our multifamily peeps. He's got a lot of experience, and we're going to talk about multifamily, about the market today. So super excited. Brennan, thank you very much for hopping on the show.
Thanks for having me, Gabe. Good to see you.
Absolutely. I told you before we got on here, we like to start with stories. We like to hear how people got into real estate. So why don't you take us to the beginning? How'd you get started in real estate?
Yeah, it's actually an interesting story. I was in college and somehow I was trying to read a lot of books at the time. I stumbled on Rich Dad, Poor Dad. And at the time,
Purple
I knew
Bible.
virtually nothing about finance, nothing about real estate investing or anything like that. But it was just like such a dumbed down way to look at the world, kind of looking back on it now today, that it like completely changed my life, funny enough. So I was trying to kind of follow the path to law school at the time. So this would have been like my junior year of college. And I read this book and it absolutely shifted what I wanted to do. I wanted to be a real estate investor. And so my first like stint or experience in real estate was I called up the guy who was my landlord at the time and just asked him, like, can I shadow you? He was a small investor. I think he owned like 5 or 6 duplexes and triplexes in the Tucson area. I went to University of Arizona, and for no money or anything like that, I just kind of followed him around. So I went to some like city planning meetings. He was working on some new developments that he was doing, so I got involved in that. I had lunch with him one time. I specifically remember him teaching me what a cap rate was, like as like fundamental, like bare bones as you could think of. And I really got a taste for it and loved it. And so I moved out to Los Angeles once I had graduated, and started looking for a job. I didn't really have, other than that like short stint, any real estate experience. My degree wasn't in real estate. So I kind of stumbled into a unpaid internship with a pretty prolific developer named Bob Champion when I first moved out to Los Angeles, and got kind of lucky. And at the same time, I was kind of, because I couldn't survive very long on an unpaid internship, I was looking for different avenues. And I got another internship that was paid $10 an hour with a group called MJW Investments that did
$10 an hour in LA. I feel like that is
it
not
was
going to cut
tough.
it.
It was tough. I remember, discretionary income was non-existent at the time, but I think it was a good learning experience, and taught me a lot about living on a budget. But I had built up a little bit of savings from working in college, so I had a little bit of runway, but it was quickly deteriorating at $10 an hour. So I was working at both for a while, and then I got this big promotion at MJW from $10 an hour to a salaried position at $30,000 a year. And so I stopped at the unpaid internship and focused on my career at MJW, and I really was just kind of in the right place at the right time. Basically, the principal's entire team left like in the night to go start their own shop. And so at this point, I'd been working there for probably 60 to 90 days. So like I had good rapport with the main principal. He was a very prolific developer in Los Angeles, and also had built up a sizable, about just under $1 billion portfolio of retail, mostly multifamily, some student housing at the time. And so he had a good diverse portfolio to start with. And at the time, we were doing receivership and REO management for bank. This was kind of like at the tail end of the great financial crisis. And so I got my first work for him in managing highly distressed deals for either the bank or kind of pre-foreclosure with as an appointed receiver. And so these guys, everyone left kind of overnight, and he had a decision, like, do I go out and hire a whole new high salaried team, or in his eyes, do I take kind of the guy who's left and see if I can kind of build him in as my right hand man, and kind of start a growth pattern back then from there. And
Wow.
luckily for me, he chose the latter, and he pulled me into his office one day, and he's like, are you ready to, really put your time in and increase
Sink or
your learning
swim.
curve? Yeah, and he just threw me into stuff. Like I had the funniest story, and he always tells it when I see him, is we had a takeover of like a 200 key hotel in Southern California. I knew nothing about hotels. Like I didn't know what the average daily rate meant, like any of like the vernacular, and I still probably don't today. And I was in charge of leading a takeover strategy meeting with every one of the employees of the hotel. So
Oh,
like
geez.
your head of staff from every different department, from like food and beverage, maintenance, all that kind of stuff. And we sit in, and and he wasn't there. So it truly was sink or swim. And I had to kind of figure out how to lead this meeting.
He put a lot of
Um,
trust in you there.
yeah, so a lot of kind of blind trust in me at that point. But I think that really kind of, put me in a position where I had to kind of build a lot of confidence in myself and figure things out on the go. And then around 2012, late 2012, 13, we hired in another partner to lead acquisitions. And then we kind of turned down the receivership and REO business, and got back to what he had really gotten or been successful in, which was acquiring assets and raising capital. And so we built, by the time I left, which was 2017, we were one of the top 25 owners of private owners of student housing in the country.
Oh, wow.
So a lot of my first career was in student housing, with a focus on kind of student housing and value add multifamily. Around 2015, a friend of mine from college approached me, who's now my business partner, Devin, and he said, "I've got a little bit of family money. I would love to invest in real estate, but I don't really have much of a background in it." He'd kind of seen what I'd been doing at MJW, and that led to us doing our first deal together, which was that we paid $860,000 for it. It was a 9-unit property in Pico Union. It was built in 1912, I think.
Wow.
And I mean, it was like the traditional Los Angeles multifamily value add story. Like the tenants were all paying, 50% below market. It was a rent control deal. And we kind of built a business off of doing a few of those while I was working at MJW. And I'd also gotten into the USC MRED, Masters in Real Estate Development program. So I was kind of doing all three of those at one time. I finished the MRED, and then by that point in time, Devin and I had built a portfolio of, I think, 6 deals. And my kind of side gig had started to outweigh, from an allocation of time perspective, my day gig. And at that point in time, I made the election to leave and focus on raising additional outside money, outside of just his family's. And that was kind of the point of inflection. And since then, that was 2018. Since then, we've built about 3,000 unit portfolio, which is about 600 million of assets under management. We've exited, so gone full circle on I think 17 or 18 projects now. Built a good track record. Started to raise money from institutional investors, large private equity groups, and stuff like that. So that's the story of how I went from reading Rich Dad Poor Dad to the portfolio that we have today.
That's awesome, man. That is it sounds like, lots of ups and downs. I love that you kind of were thrown into the deep end with that
Yeah, it was
original
fun.
mentor.
Yeah,
Yeah.
it was fun.
I feel like it's during those times that you really you build your confidence because you're going in there and you're like, fuck, I don't know what I'm doing, but you come out the
Yeah.
other side and you're like, if I make it through that, I can make it through anything. So
Yeah, you got to develop some thick skin in this business, and I think that helped me do that.
yeah, yeah, for sure. I actually kind of started the same way. I was also going to planning on going to law school, but I read Rich Dad Poor Dad, and
Okay.
I think they need. I just feel like the university curriculum or even high school curriculum needs to add in an investing course. There needs to be some step
Or
where
even just
people read.
reading that book, like it doesn't get any simpler than that, like the way that book like outlines how to invest. And even if it's not in real estate, just like the ideology of it, I think I think society as a whole would benefit from having that as a mandated curriculum.
Yeah, absolutely. But man, you guys have had great success since 2018. You got up to 3,000 units. That's a hockey stick right there.
Mhm.
You had experience in student housing. I'd love to dive into both of them. Student housing is something I actually don't know a lot about.
Yeah.
It sounds like a great asset to be in. When you're talking about student housing, does that include single families that you rent out room by room, or is it just
No, so
multifamily?
what at least what we looked at was primarily what our business model was trying to buy a little bit older um conventional product. So not the like purpose-built stuff you see today where it's like 4 bedrooms, 4 bathrooms, equal parity and new highly amenitized product. What we would try and find were a little bit older product, and historically things weren't built that way. Student deals were built as conventional style deals up until a little bit more recently. So what we would try and find is those type of deals, but that were like main and main on campus. So like we bought a deal at University of Michigan that was literally like off the steps of the entrances. I think it's called the Diagonal or the Zag or something like that on campus, and it was like a 1970s project, single owner for the last 30 years. And we bought it and did a pretty large scale renovation. It was a tower, added like a rooftop deck, renovated all the units, tried to add some amenities with like the addition of a gym and a cooler leasing office and stuff like that. So what we would try and do is buy a little bit older product that we could draft off of all the super high end, highly amenitized stuff, and then add a little bit of amenities and stuff, add a little bit of a coolness factor to the older product, and really cater to what we saw was, the average person at the university. So not like the high end students, with the very wealthy parents. It was like, who's your average person going to school here? Let's get them close to campus so they can roll out of bed and be in their classroom in 10 minutes. But like put them in a nice unit that's not really run down and stuff like that. So that was more of our business model. But the reason we don't invest in student housing anymore, or that I elected not to when starting DB, was it's really, really hard to manage. And like the
Mm-hmm.
the dips and dives and like the highs and low and from an
Property
operations
damage.
perspective
Yeah.
are just a grind, and it's every year. So you start really in like October, and you do this whole marketing and pre-leasing strategy and this ramp up in your rates and this like heavy amount of strategy, and where do you start and where do you want to stop and all this stuff, and like you get through that and it feels like you've just been in battle for the last 11 months, and then the dust settles, you get all your move-ins, and then the summertime's inevitably crazy with especially if you're trying to renovate. And then like everyone moves in, dust settles, and it's like 2 weeks later you start it all over again.
Yeah.
So it's just a lot of work, and what we saw was that you just didn't get paid for that amount of risk and work
Yeah.
as it matured. So when we first really started to go heavy into student housing, it was really like 2012, 2013. And I specifically remember a pretty significant yield premium. So if we're talking just cap rates, probably 100 plus basis points between conventional deal and the student housing deal is where you would see things trading. Um, and so you got paid from a yield perspective for taking on more risk and taking on those operational challenges. And we really saw those kind of the gap shrink significantly. And at points in time, because it was such a like sexy asset class to be in, it even inverted depending on which markets you're in. So it just didn't feel like you were getting paid for that risk anymore. So I think more of it was I didn't want to be starting a company that had those kind of operational challenges. It just takes a lot of resources, a lot of bandwidth. It's tough to scale because you really can only, for concentration reasons, you don't want to buy more than a handful of deals in any one market. But generally, student housing markets are pretty small, and so supply demand can shift overnight on you or in one leasing season, and you find yourself having to take multiple flights to get into a market. Like we had deals in Pullman, and I have to fly
Oh
through
yeah.
Seattle and
Yeah,
then get on
Wazoo,
one of
yeah.
those little prop planes and fly into Pullman. And 9 times out of 10, like the flight back home got canceled. The times I had to drive from like Pullman back to Seattle, catch a flight from
Five
Seattle
hours
back
right
to
there,
LA.
yeah.
I just wasn't
And
interested in that. So it's a great asset class. I actually think it's probably I haven't really looked at it a ton or spent a lot of time on it in the last few years, but it's probably a good time. It's kind of a counter-cyclical business. Usually in recessionary times, student housing holds up pretty well. But I do think that the way it matured and how much more institutional capital kind of came into the market kind of took away a lot of the benefit that we were finding early on when we first started going after it.
yeah, yeah, that makes a lot of sense. And I've actually seen a lot of articles on my like Google feed with different universities closing because
Yeah,
admission rates are going down, and cities like Pullman, they are Washington State University. Like Pullman
there's
doesn't really
nothing else.
exist.
Yeah,
Exactly.
yeah,
And so if you're 100% dependent on one employer,
yeah.
that's
It's
a lot of
tough.
risk.
Yeah, we tried to hedge that by always looking at universities that had very strong sports programs. That was kind of like one of our secret sauce outlines, was that we knew that that would always generate a captive audience for
Mhm.
enrollment there. Like, so like a University of Texas or University of Michigan or something like that, regardless of what happens on a macro level with the student environment, you're always going to have demand from people who grew up and they were a fan of that school, and especially at schools like Texas and Michigan that also have a very prestigious reputation education wise. Like those were the type of schools that we would really target because we didn't see those losing admissions to online enrollment and stuff like
Yeah.
that over time.
Yeah, that makes sense. So you're not going after the small private universities
Yeah,
that nobody's heard
yeah,
about. Yep.
yeah,
I don't want to spend too much time on student housing, but one last question that I am kind of interested in when you're looking at investing in student housing for anybody out there who is interested, generally how many blocks away from campus would you consider to be student housing, and at what point
yeah.
do you think it's just regular residential?
So it's a complicated answer depending on which market you're in, because there are markets like Lubbock, Texas is one that we were in, Texas Tech, where you had your student, like your student housing that was all within a couple blocks radius, but you also had, because of just where you were able to build, like your quote unquote bus route student housing, so
Oh
that
yeah, okay.
they had a shuttle that serviced it, and that was still purpose built. I would say that that is where we saw a ton of risk, and we didn't want to, like, we tried that deal, we got in a good basis, ultimately did well on it, but it was for the supply demand reasons. That becomes very difficult. So I would say I think that our general barometer was we would pick the main and main location of campus. So like at University of Arizona, it would have been the mall. At University of Michigan, it was the ZAG or whatever I was talking about. And we would say we need to be within a 10-minute walk to
Mm,
that. And
yep.
so a lot of universities that just ruled out in general because the product just didn't exist. So we had to spend a lot of time trying to dissect which markets had that type of product that fit our thesis, that we wouldn't be getting into and being exposed from a location perspective, because that's really where you live and die. Is if um, in the student market, like you deliver beds at generally the same scale as you would conventional housing in like Seattle or something like that. So typically a developer is going to be building economies of scale around 200 to 300 units. In a student market, that could be 5% of your supply,
Oh
that one
yeah.
project. Whereas in Seattle, that's a rounding error. And so what we saw is, using Lubbock as an example, is that like overnight in 18 months, they put up, I think it was 2,000 beds delivered. And it was all because the universities publish these reports that say, we're going to try and, tier up in university, and we're going to try and get from, X amount of students to Y over, a 10-year basis. And that's a lot of what developers follow. But what happened in Lubbock, and I think this would have been like 16 to 17 or 17 to 18 or around that time period, is they had very ambitious growth expectations published. So you had this flood of developers come in, and I think it was about 2,000 beds that occurred in one leasing cycle. Deliveries occurred in one leasing cycle. and then the university didn't hit their target. So
Mm,
you had this huge steep increase in supply and you or demand, supply, and then you had flat demand, and then it was just a bloodbath. Like it was a
yeah.
concession war the next year. And so going back to your main question, that's why it was so important, is because that's how you really insulate yourself from those future supply influxes. If you're close to campus and there's barriers to entry to building more product near you, you're always going to be someone's first choice, regardless of like how well amenitized and stuff like that some of these deals are. If you're an affordable deal that's within 10 minutes of being at their classrooms, like that building's always going to be full.
Yeah. Yeah, that makes a lot of sense. It's funny you mentioned Lubbock. I actually I bought a self-storage facility down in Lubbock. It was literally three blocks from Texas Tech,
Mm-hmm.
and we it's I feel like those areas are interesting because the net rentable square feet for the market in Lubbock is overbuilt, but that specific area wasn't. And
Yep.
we were talking before the show. Crime is a big thing that I look at to make sure that we don't get a lot of vandalism. But we bought it, and it turned out that this was actually kind of a bad area.
Yeah.
And we didn't get the leasing that we expected. We thought, with student housing, there'd be pretty easy to lease up, and it didn't turn out to be
Yeah.
that. But
Students are cheap, so they'll
yeah,
find they'll find any means necessary to store their stuff before they pay you $100 or a month or whatever it is.
yeah, absolutely. All right, let's shift gears a little bit here. We are running down the clock, and I want to get into multifamily before we switch over.
Sure.
You guys are at 3,000 units now. That is awesome. You went from, I think in the beginning you said like 9 units was your first deal.
Yeah, 9 unit deal was our first deal.
Okay. So let's talk about scale. So what was the point at which allowed you guys to scale to the 3,000 units? Was it capital raising? Was it?
Yeah, so it was kind of an iteration of multiple inflection points. So like the first one was like if I just look at kind of the milestones, it was doing well on our first off balance sheet deal. So the first time we raised money outside of doing it ourselves, because that was the first iteration. Is we bought 6 deals, they were all with our own capital, or primarily Devin's family's capital. And we did really well on those. So we built a track record. So we kind of established a small track record. And then that is what helped propel us into that first deal with a new, more traditional joint venture partner. I think it was like $2 or $3 million of equity. And then we did really well on that, and that led to kind of scaling. I think we did 5 deals with that same joint venture partner, all within like a closing within like a 1 year time frame, and then kind of got through those, and then built a track record off of or outside of just our own capital. And that's really when the wheels started turning, is because a lot of people don't want to be like or a lot of groups don't want to be your first investment, rightfully so. And so it was kind of that iteration, getting outside of doing stuff just on our own balance sheet, getting that first investor to believe in us, and then doing well for them is really what catapulted the next. And if you look at it, it almost just reinvents itself every time, because like the next stage is, how do we do well for an investor that can write us a $10 million check? We've done really well for all these investors that can write $2 to $5 million checks, and now like the next stepping stone is doing well for an investor that can write big checks, and we did that. And then that creates all this extra momentum and stuff around your platform. So I'd look at it and say like each time it was a stepping stone that resulted in the continuation of that growth trajectory.
Yeah, that makes sense. You guys started, you did well on deals you bought with your own money, and then you
Yep.
went to a one-on-one kind of JV. You found an individual capital partner. He put his money in, you did well there, and then you scaled up. Are you guys kind of doing the fund model now, or are you
So
talking
we're in
to
the
high net
process
worth?
of raising our first fund.
Okay.
So that's again the iteration continues, and so everything we've done to date has been on a direct basis. So we'll find a deal, we put it under contract, we underwrite it, we put a package together, and then we go make the market on the equity side, try and get a couple term sheets, use that to negotiate economics, and then we've got a joint venture partner. So that's been how we've raised how 250 to 300 million that we've raised today. Our next iteration is we have we're in initial conversations on an anchor to anchor $150 million fund that will start kind of that progression as a discretionary fund manager for our own deals. So we don't have any intention of trying to become like a private equity group that invests in other people's deals, but that'll kind of have our in-house capital source. And so what we're trying to do over time is continue our path of being fully vertically integrated. So we have a construction company that's based in Dallas. We just did a joint venture with a property management firm. So we kind of tried to combine forces and use the size of an existing partner and introduce a joint venture to allow us to have a little bit more control and dedicated resources in our own assets. So we're kind of a hybrid third party in-house property management arm. And so I think that the next progression for that vertical integration is to have funds in-house that we manage, and we'll still do deals direct with some of our preferred capital partners, but I think that will start to hedge the need to like tie up a deal and then go scramble around for weeks trying to get equity lined up. It'll kind of be more of a we need to get some fund money into it alongside our joint venture partner on bigger deals. Maybe the fund is 100% of the capital on smaller stuff, and so it'll just allow us to be a little bit faster to execute and more nimble.
Yeah. Yeah. The fund model to me is definitely appealing. I'm in, I go to individual investors and, a syndication model, but the fund model, when you just have the money ready to execute,
Yeah.
that sounds,
Especially for times like I think we're going to see over the next 12 to 24 months where, I think there's going to be a tremendous amount of opportunity. I think our industry experienced a significant amount of over leverage and creative financing over the last few years as things were very frothy. And so I think being able to have a captive base of capital to deploy at a better basis is really going to be what kind of separates a group like us from having to pool together retail money once we find a deal.
and you guys only invest in LA, correct? Or are you guys
No,
nationwide?
actually, we don't invest at all in LA
Okay.
anymore. So we started in LA and we saw the political landscape continue to make it more and more challenging for us to kind of control our own destiny. Rent control. You see, if you know about the mansion tax that just passed, like all these different hammers that have come down over the last few years make it really like it's stuff that you can't underwrite to. Like there's no like line item in your Excel model that's like political risk. And so that
50%.
was one of the reasons that we kind of shifted out. And so we invest in Texas, Colorado, Utah, Arizona, and Nevada right now. So kind of Texas West, but try and stick to more landlord friendly states, although Colorado's pendulum is kind of swinging. But we've owned in Portland, as we were discussing prior to this, and we've owned in LA, but kind of made a thematic exit out of those coastal markets over the last few years.
Yeah, I'm looking a lot in Texas myself. I love Texas. All the major
Yeah.
metros out there are just growing like
Yep.
gangbusters. I love it.
Yeah, we're big in
Um,
Austin and San Antonio. We are looking in Dallas. We don't own anything currently in Dallas, but it's on our kind of to-do list. But we have a decent amount in San Antonio and Austin already.
nice. All right, before we switch over to the quick question round, you mentioned earlier, you said you kind of have a hybrid management model, property
Yep.
management model. So do you give equity to your third party property managers on the deals, or how does I didn't quite follow
No,
you there?
so the joint venture is actually an entity between DB and the property management firm that our management flows through essentially. So it's kind of a drop down for each. And what we're able to do is from the fees generated from our portfolio, we have a dedicated staff on the operations side. So people on the operations team that only oversee our our assets. And that was one of the main things I was focused on when trying to decipher between third party and in-house. Is like I'm by no means is my experience in the property management industry, but I've witnessed the importance of having, those dedicated, your regional supervisors and stuff like that be focused just on your assets. Because otherwise what ends up happening inevitably is like, everyone has like probably weekly calls and stuff like that with their operations team. And what I hated was the feeling of like, I just gave, regional manager of Texas 70 different action items for the next week. What happens when that person hangs up the phone and they have 3 more of those calls that day from other investors? And so what we tried to solve for was to have dedicated resources for the like day-to-day operations side, and then leverage the large back office that the management company already had for things like accounting and marketing and all like kind of the behind the scenes stuff. And so we did a joint venture agreement with them to basically house our dedicated resources for our portfolio. And so that's why I say it's a little bit of a hybrid. At the end of the day, it's really that we have strategic alliance with this property management group with dedicated resources for our day-to-day management. Whereas on the general contractor side, it's, we own half of them, and they really only do work on our portfolio. They do a little bit of third-party stuff, but we've been busy enough over the last 12 months that we've really been focused on just being the GC on our own value add projects.
Nice, man. I love it. All right, we have run down the clock, so it is time to jump into the quick question round. Are you ready?
I am.
Let's do it. Starts. Well, you've kind of already answered this one, but I'm going to ask it anyways. It starts with books or any form of education. Give me 1 or 2 recommendations, actually. 1 for general life wisdom, and then 1 real estate specific.
Got it. Yeah. So one of my favorite books for general life wisdom was Outliers, Malcolm Gladwell.
It's a good one.
Again, kind of around the same time period I read that, and it dovetailed into my, having a focus on building my 10,000 hours. So Outliers for general life stuff. I mean, I think the easy answer for the real estate side would have been Rich Dad Poor Dad. I'm trying to think of a real estate specific book that I've read. I mean, some of the content from my master's in real estate time at USC is a lot more boring, like textbook type stuff to read,
Yeah.
but is helps build a good foundation. So I would say, for ease of conversation, the Rich Dad Poor Dad. I mean, that definitely was life changing as far as real estate. That's what got me into real estate. So I think I have to go that direction.
Yeah, that is a solid recommendation. It's been echoed many times on this podcast,
I'm
but for good
sure, yeah.
reason. Yeah, it's
Yeah.
it's a
And
good.
you can
solid...
read it in like an afternoon,
Yeah,
and it's pretty easy.
exactly. All right, moving on. This is for your younger self. So let's go back to the Brennan, the one who was getting $10 an hour at that internship.
Yeah.
Go back to him, look him in the eye, give him 1 piece of advice moving forward.
The one piece of advice, I mean, the one big mistake that we make mistakes every day, so this is hard, but I think the biggest mistake as far as like the how it impacted the trajectory and the trajectory of our business and my stress levels was when you get ready to start different partnerships, how important it is to clearly identify the roles and responsibilities of the different people who are involved. And the reason I say that is we had a very time intensive, expensive, Devin and I had a very time intensive and expensive learning relationship when we tried to go into a co-GP platform with another. They called themselves a family office, and it really didn't end up turning out that way. And what we failed to do on the front end was fully do our DD and understand who it was we were partnering with, and then outline what are each side responsible for. Because when you're starting these partnerships, especially between friends, it seems so friendly, and it's almost like morbid to discuss some of the stuff you need to in your partnership agreements. And so that would be the one thing I would tell my naive self is like, you got to put the friendships aside and really focus on, for this partnership to work, what do sides, X, Y, and Z need to bring to the table.
Yep. No, that is timeless advice, and it's very important, especially with partnerships, to just for the ease of execution, to really know which lanes everybody's in. So great advice
Yeah.
for your younger self. I'm going to move us on to the next one. This is about positions in your company. So your company lives and dies by the people in it.
Yeah.
We're not talking about individuals here, but what are the first three positions you hired for, and would you do it differently if you started today?
Yeah, so the first positions I hired for were for deal flow. So they were really acquisitions positions. And what the way we structured it was that each position only covered up to 1 to 2 markets. And in Texas, it's now 3. So it's DFW, Austin, and San Antonio. And I would not change that had I needed to do it over again, because what we've been able to do, and going back to our student conversation, is I learned it is so important to know your market inside and out, and be a local, and know where the next coffee shop's coming up, or bar, or restaurant. You got to what zoning overlays are in the pipeline, all that kind of stuff. And to do that across a bunch of markets for myself is virtually impossible. And when I say student housing was tough, is because you got to parachute into a market. You see a deal, you might not own anything else in that market, and you got to figure out, not only do you like the deal, but do you like that market, all within the same kind of general, like 60 to 90-day closing time frame you would conventional deal. So that is the way we structured it. We have a regional vice president that oversees acquisitions and asset management in Texas, Colorado, and Arizona. And those each cover up to 2 markets. And that's really allowed us to be a local in a much more larger geographical setting. And so I wouldn't do that over again. I would hire a CFO earlier if I were to go through this again. My background was not accounting. I know enough in accounting to be dangerous, but it's definitely not my specialty. And basically I was the one, accounting and finance. I was the one doing all of that stuff up until more recently, when we hired a really good experienced CFO who's taken mounds and mounds and mounds of work off of my plate and increased the level of sophistication in our financial reporting, and just the way we move around money and stuff like that. So I would hire that earlier if I would to do it again.
Yeah, that is really good advice. Tax time is my least favorite time of the year, just because I have to, hit your head on the wall for
Yeah,
all the just the mess that
it's
is
kind of like
US
student
taxes.
housing. It feels like you're in this battle for months, and then the dust settles and you wake up and you have to do it all over again. I don't know about you, but our tax season, doesn't really officially end until like October.
Mm.
Most of it's
You guys
front
do
loaded, but
extensions,
like
yeah.
it keeps going for mine and my partner's personal tax returns up until like October. So it feels like by the time you're done with it, like you're already starting over again for that year.
Yeah, it's the worst. All right, moving us on. This is about deal flow. You just talked about the positions. You started off with deal flow. So what is your favorite way to find good deals?
Yeah, I mean, it's the sexiest word in our industry is off-market deals. And so like what does an off-market deal actually mean? So some of the best deals that we've done have been, brokered deals, but from kind of semi-distressed situations. A lot of the best deals we've done have been through the need for changes in estate planning, or like, the patriarch dies, passes an asset to the children don't want to manage it. Like, those are some of the best deals we've done. So I would say that general profile, and they typically come a lot of times from the brokers you don't expect them to. Like, so not like the CBRE office that manages,
Yeah.
does $1 billion a year in deal flow in that market. A lot of times it's like that KW broker who knew the family somehow. And this might be the only multifamily deal they do that year. And you have been, cultivating that relationship for years to get to that point where it finally hits and you find a deal that makes sense for you. So I would say some of our best deals come from the least likely places. And so if you want to be a market buyer, you got to stay in touch with, the big shops and stuff like that are doing 90% of the deal flow. But I think to pick off, those one or two unicorns every once in a while, you gotta kind of cast a wider net as to who you're building relationships with.
Yep, absolutely. And I've actually found the same thing. It's not, I have reached out to a few big, you know, um, big time brokers out there for self storage, but I've often found really good deals come from just the small
Yep.
time brokers who, you're right, just happen to have this one relationship with a guy who has a self storage facility and he wants to sell.
Yep.
And they
It's
just,
a it's amazing how fragmented compared to other markets the real estate industry is. It's a small world, so like generally everyone kind of knows each other and stuff like that. But the way deals are bought and sold is pretty fragmented when compared to other industries.
yep, absolutely. All right, I'm gonna speed us up a bit. This is second to last question. This is about mentors. None of us are none of us are giants. None of us are islands. We all stand on the shoulders of giants. So, who is
Yep.
one mentor who has contributed significantly to your career today?
Can I pick two? Because
Go ahead. Yep.
okay, so two. So first one was my boss, Mark Weinstein at MJW, the one who kind of threw me into the fire. Still a close relationship of mine today. And I think without what he did, I wouldn't be sitting here talking to you today potentially. Second was my partner's. He's technically my partner, but my partner's father, Bob Anton. He was the one who believed in me and his son to get us going, and as a former publicly traded CEO, company CEO, he just brings a completely different set of experience and ideology to the table that really has helped me a lot as I manage a growing company. So different eras of my career, but equally important in my eyes.
Nice. I love it. Well, thank you, Mark and Bob, for getting Brennan to where he is today. That leads us to the very last question. You've given us a lot of good advice. I'm sure people want to reach out. What does your company offer? What are you guys looking for? And how can listeners get in contact with you?
Yeah, best way to get in contact with me, you can go to our website, which is dbcap.com. You should be able to find my email address and LinkedIn on there. We do, even though we didn't get into it a lot, we do offer small amounts of syndicated capital in each of our deals. So to the extent your listeners want to pick up some deal flow and see the type of opportunities we present, we generally carve out a little bit of equity on every deal that we do. For kind of a friends and family or individual investor type round as well.
Nice. All right. So that is dbcap.com. I will put that link in the show notes. If you guys want to reach out to Brennan, just click a little more in the description. It'll pull down the full description, and in there you can find Brennan's URL. All right. Well, hey man, that wraps it up. Thank you very much for hopping on the show.
Thanks for having me. Appreciate it.
Absolutely. For everybody who's here with us, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at realestatinvestingclub.com. If you guys want to support the show, all we ask is you give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode. Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started or an established investor looking to take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value.
And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investors Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesalers Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the Ebook Bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.